Good afternoon, everybody. Welcome to today's live event. My name's Andrew Wilkinson, and I'm joined by Matt Cashman of the OCC. How are you, Matt?
I'm doing well, Andrew. I'm pleased to be here today.
We love having you do these wonderful events with us. Tell us a little bit about today's topic, iron condors and butterflies.
Absolutely. Today, we're going to dig into iron condors and butterflies, which are really kind of like the beginning of complex spreads. Things, obviously, if you want to get super complex, can get crazy. And you can add strikes and quantities and all kinds of things. But I'm going to dig into iron condors and butterflies. But the first thing I'm going to do is break it down into the component pieces of those iron condors and butterflies, which are essentially credit spreads, credit call spreads and credit debit spreads. And then we're going to stick them all together and give you an idea of how to look at the risk holistically and be able to see how those positions act more broadly, which should be
looking
fun.
Forward to it. Matt, I'm going to make you the presenter so that you can share your screen with the audience if you want to do so now. Just a bit of housekeeping, people on the call. Thank you very much for joining us. It's a recorded event, so you will receive a link to the recording about 2 hours after we've wrapped up talking here today. The handouts from today's session are available in the GoToWebinar panel there. Just expand the handout section and you'll see a link to the PDF. Please do feel free to put questions into the chat panel, and I'll keep an eye on those. Q&A with Matt towards the end. Matt, I'll tell you what I will do also. I'll make you an organizer so that you can see any questions coming in too.
Excellent.
And but I'm going to keep an eye on.
Also, Andrew, I am very organized, which is also helpful if I'm an organizer in this context.
Yeah, you've probably got a dog sitting down there nice and quiet behind you as well. Just
not today. Empty dog bed today.
All right, Matt, you're good to go.
I think I lost your audio, but I'm guessing you're handing it over to me, mate. So I'm gonna, there it is. All right, here we go. Hello, everyone. Thank you for joining us today for today's July IBKR and OIC webinar, where we're gonna talk about iron condors and butterflies. I'm gonna dig in, like I said, to their component pieces, some of the risk dynamics that are inherent within these spreads, and then we're going to examine some of the more broad characteristics of the spreads themselves. We're going to talk specifically about call credit spreads, put credit spreads, and then we're going to put them together and talk about the iron condor and the iron butterfly specifically. I'm going to give you some theoretical examples of how these more complex spreads might look if you have them on in your trading account. Now, my hope is that this webinar really builds on all of that simple spread understanding and risk dynamics, and give you a deeper understanding of not only the dynamics of those spreads, but also how you can put them together into these complex spreads and see how they happen theoretically, but also how they might happen right in front of you when you're looking at an options matrix, because that's really what we're getting at here. So my name is Matt Cashman. I'm the Principal of Investor Education at OCC, as well as an options industry council instructor. I'm going to give you a quick background on myself. I started trading in 1998. I've been an options trader ever since. I got my start in Chicago trading equity and index options. Pretty quickly after that, I moved to London and I traded interest rate options there for about 3 years. And then I moved back stateside and started and ran an index options market making business, again, on the floor of the CBOE for the better part of about a decade in Chicago. Currently, I work at OCC, helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like the webinar that you're watching today. On a side note, I always like to have a shout out to our incredible partner at IBKR. The education team there is incredible, and they've been a really great collaborative partner for us over the years. This is a partnership that's expanded significantly over the last couple of years. And we've added podcasts and other things as they have expanded their educational offerings as well. But it's important to note that not every brokerage firm does that out there, and IBKR is really at the forefront of those efforts, and they do a fantastic job. So a really big shout out to them. Quick disclaimer. I know you've got the IBKR disclaimer, but you're going to get mine too. Options involve risk. Any strategy that I discuss, et cetera, illustrative and educational purposes. Please do not construe past performance as indicative of future results. One other bit of housekeeping. The following trademarks and logos are wholly owned by the OCC and OIC. You'll see them used throughout the presentation today. All right. A little bit about the OIC. this is important. Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation, which is the largest clearing corporation of equity and index exchange traded options in the world. That's a mouthful, but OIC started out as a collective in 1992 to better educate the public as to the risks and the benefits of exchange traded options. Currently, we do that through the use of our website, optionseducation.org. There you're going to find courses, podcasts, videos, webinars like the one you're watching right now. You can also, this is something I always stress, options at theocc.com. This email address right here goes straight to our investor education desk, where I sit with 3 other colleagues, all of whom have more than 20 years of experience in either trading, brokerage, or the clearing business. And you can send us email questions about options and specifically about certain situations. We're not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do, and what we really love to do, and to be honest with you, what we're really great at, is educating people as to how the basics of optionality work so that they can better use that knowledge and make more informed, educated investment decisions going forward. The best part about educating someone about how options work is that if you learn it once and you really learn it, you can apply it in so many different possible permutations and different asset classes. The optionality exists the same way across different asset classes. And once you learn it, it's a different way of thinking that you can apply in so many different ways. So it's important. Make sure to send us email questions at options@theocc.com. That is a place where you can get real questions answered by real people that day. So here's the options volume for the last 23 years. If you take a look at this, I always add this at the beginning of my presentations because it's really important to drive a point home, which is that the volume in general has exploded. People are more involved and more involved on a regular basis. There's just more people involved. I think part of that is that people are starting to wake up to the idea that options are a really strategic investment that they can utilize. But it's also just the breadth of the amount of people that are playing in the marketplace. If you look at this in 2008, we cleared about 3.7 billion contracts. By contrast, in 2023, we cleared about 11.2 billion, and we're on pace to clear roughly 12 billion or more this year. These numbers are staggering as far as volume is concerned. And what it points to from my perspective is that there's so many more people involved in this marketplace, and all of those people need to understand how these options and these leveraged instruments work so that they can best use them when they align with their actual investment goals and risk tolerances. That's the most important part. So that's why we do everything that we do every day. But it's important for people to understand the actual scale that we're talking about as far as the options business is concerned. Over the last 20 years, it's been an incredible expansion of people into that business. So let's talk about what we're going to talk about more specifically today. I told you we're going to talk about vertical spreads quickly. I'm going to brush over vertical spreads in general, and then we're going to talk about call credit spreads and put credit spreads, which are the building blocks of the Iron Condor and the Iron Butterfly. And then hopefully at the end, we'll have some time for Q&A with Andrew. Let's dive right into the actual vertical spreads themselves. A spread involves 2 or more positions. For those of you who have traded a bunch, this may be very, this may be a kind of beginning idea of how these things work, but I want to make sure that people understand. It is a buy of one option and a sell of another option. Generally speaking, these spreads happen on the same underlying with the same expiration date, but they have different strike prices and maybe different quantities. It's not always the same quantity. Sometimes they're different quantities. Sometimes they're the same quantities. But it's important that you understand, especially when people start out trading spreads, generally speaking, they stick to the same underlying, the same expiration date, but different strikes. Spreads now can also involve stock position. Many times what people will start out with when they're talking about spreads is they'll start out by trading covered calls or married puts. Covered calls are a long stock position and a short call position together as one. Married puts or covered puts are a long stock position and usually a downside put position. Now, in one of those, the covered call, you're usually short the option and long the stock. In the put, you're usually long the put and long the stock. So there's slight differences there, obviously, with the optionality and whether you're long or short it. But spreads themselves can also involve stock positions. And sometimes covered calls and protected puts are actually quoted as spreads. And they're quoted sometimes as one big notional number for the amount of cash that you would need to outlay to, for instance, buy the stock and purchase the put. And so it's important when you're thinking about that you also think about, spreads can involve stock positions. They're not always just credit or debit spreads. So vertical spreads, you're buying one option, you're selling another option. Like I said, it's usually the same underlying, different strike prices, but they have defined risk reward characteristics. This is one of those things that most people like about spreads. And part of the reason why so many people, I think, have kind of woken up to the fact that using them can be exceptionally versatile. They have defined risk reward characteristics, which means oftentimes if you're buying a spread, you can actually only lose the amount that you're paying for the spread in that case. If that's all you have on, if you're long one option and short one option and you have a spread on, especially if they're vertical spreads like this, and I'll get to that a little bit later on in the presentation with some real world numbers as far as how spreads actually act when stocks go through strikes and things of that nature. But the defined risk reward characteristics are really inherent within these spreads, and it's part of the reason why people like to trade them. Now, there's two main types of spreads, obviously. There's a debit spread and a credit spread. You can do debit spreads on calls and puts. You can do credit spreads on calls and puts. Today, we're going to focus on the credit spread portion of it because those are the building blocks of the iron condor and the iron butterfly. But debit spreads can be built into these positions as well, depending on how you actually, how you leg into it or how you build it. But it's important from my perspective, when we're learning about it, to learn about it from a credit spread perspective first. The debit spread, obviously, you're paying premium to initiate the position, and the credit spread, you're receiving the premium to initiate the position. So in a debit spread, the option you're buying is going to be bigger than the option you're selling. And in a credit spread situation, the option you're selling is going to be bigger, and the option you're buying is going to be smaller. That's what creates the debit, the total debit, and what creates the total credit for those spreads. All right, let's talk about the call credit spread specifically. Why are we trading call credit spreads in general? The motivation for a call credit spread is generally neutral and or bearish. Neutral or bearish. Why is that? The reason why is because calls are generally positively correlated to underlying price. And so theoretically, the spread, the call credit spread, the call spread specifically, is theoretically going to go up in value as the stock goes up in value. That's what the actual positive correlation actually means. Thus, if the stock goes down in value, theoretically, your call spread should go down in value. Again, the positive correlation here. What that means is that the call credit spread, the selling of the call spread, inherently is a motivation from a neutral and or a bearish outlook on the other. Now, again, it has defined risk and reward. Why is that? Because it has both long and short optionality built into it. You're long one strike and you're short another strike. In this case, because it's a call credit spread, you're short the bigger strike, the bigger option. You're short the bigger option and you're long the smaller option, but it still has defined risk. The reason why is because that spread itself can only be worth a certain amount. In this case, it can really only be worth the difference between the strikes, especially if you have it on 1-to-1. I'll talk about that in a little bit more specifics later on. Generally speaking, they have favorable break-even points if you are receiving credit. So you need to think about creating or thinking about your break-even point by adding the credit that you're getting to your theoretical break-even point. I'll show you that in a moment. But also the profit potential is extremely heavily influenced by the amount of credit you're taking in. meaning the more you take in, the more credit you receive when you sell these spreads, the more your profit potential is. Why is that? It's because the most you can make on a credit spread is what you sold it for. If that's the only position you have on, that's the most you can make on a credit spread. If it's both strikes in the same month and the same quantity on both strikes, that's the most you can make, is how much you sold it for. Now, the risk control portion of this is also really important. I talk about this in different terms, but in this case, the reason why I think risk control becomes important is because you have both long and short optionality built into this position, this theoretical position. Anytime you have both long and short optionality, it matters a little bit more where the stock is relative to what strikes you have on. And so you need to be paying attention a little bit more closely to where the stock is relative to your strikes, because that's going to affect whether or not you're long or short premium. If the stock is actually closer to the strike that you are long, you might actually, the position itself might actually act like your long premium, even though you have what you think is a call credit spread on. And theoretically, it is a call credit spread. If you're closer to the long strike, the actual decay of the options is going to affect your position in a different way. And that's why the risk control portion of this is important. And that's why it's important to pay attention to where the stock is relative to your strikes, especially when you have spreads on. But the risk control portion also includes defined max loss. Like I said, this is the most you can lose on a spread like this, is the difference between what you sold it for and the total amount that it can be worth. If you're selling a 5-point call spread, the most that 5-point call spread can be worth is the difference between the strikes, $5. So it has defined max loss. Again, position monitoring is critical in this situation. Why? Because you have both long and short optionality built into one position. It's important to think about it that way. Also important to think about it once we start taking these building blocks and building bigger and bigger positions into these complex spreads, even more important to understand where am I long optionality, where am I short optionality, and where is the underlying stock relative to those two strikes. Let's look at a real world example here, a theoretical real world example. Stock XYZ trading 88.5, you got 28 days to expiration. This is a call credit spread example. So the 90-95 call spread. You're theoretically going to be selling this spread. That's what creates the call credit spread. You're creating a credit by selling the 90 call for $3.50, buying the 95 call for $1.80. Your total credit is $1.70 that you're going to be taking in for this spread. If you were to put this trade on and then take your sheets and slide them across the table to me, and I didn't know what you had on, I would pick it up and say, okay, great, you're short the 90-95 call spread. That's the way that we generally will talk about this position. If you're looking at two traders who are talking about what they have on, and someone is short the 90s and long the 95s, and the stock's trading 88.5, generally speaking, they're going to say, okay, great, you're short the 90-95 call spread. Now, whether or not you're short at 1 for 1, or whether or not you're short at 1 by 2, or 1 by 3, or 1,000 by 1,200, it's that part can be variable. But the actual idea behind this is that, okay, you're short the 90-95 call spread. Your position's going to kind of act that way in one way, shape, or form, depending on where the stock is and how many of both of those strikes are. Like I said before, because calls are positively correlated to underlying price, this is a neutral or a bearish call spread if you look at it all on its own. It's going to do better being short this call spread if the stock is staying right where it is or it's going down in value. All right, let's take a little bit of a deeper dive into it. You're short the 90-95 call spread. Again, you collected $1.70 to sell this call spread. Always keep in mind, when you sell or buy options, the amount of premium that you sell or buy that option for is immediately debited or credited from your account. And that does not change. If you sell this spread for $1.70, the $1.70 goes into your account and it stays there. Now, that call spread can print and mark at many different prices between now and the time that it expires. So that doesn't necessarily mean it's always going to be $1.70 on your sheets, but the premium that you sell and collect for selling that call spread goes into your account immediately and it stays there. What happens after that is that it marks and that it does all kinds of things and it expires in some way, shape, or form. That's what actually creates your theoretical P&L relative to the $1.70 that you took in when you sold it, but the actual credit goes in and stays in at that point in time. In this case, your max gain's $1.70. Therefore, your max risk, remember what I said at the beginning, your max risk is going to be the difference in the actual strikes, which is the most that spread can be worth, minus what you took in already. In this case, you took in $1.70. It's a 5-point call spread. So the actual max risk here is 5 minus 170 or $3.30. It's the most you can lose on this spread. That's your defined maximum risk. Margin, of course, is going to be somewhere around what your max risk is. That's going to be somewhat variable depending on your actual relationship with your brokerage firm and how they treat your margin relative to other customers, but that's around what it's probably going to be. And your break even in this case is going to be 91.70. Why is it 91.70? Remember what I said, you add that premium that you took in to the bottom strike of your call spread. So in this case, it's the 90.95 call spread. Because you've already taken in $1.70, this position is going to break even at 91.70, which is the amount of premium that you sold on top of that bottom strike. Now, a lot of people are going to look at this spread and say, what's this thing going to be worth in 21 days or 7 days? Or, that is one way that people look at this. They look at a spread as a decaying asset, just like they look at options as decaying assets. That's certainly a possible way to look at it. A spread will have theta, just like options have theta. Theta, of course, is the Greek that measures how much your options are decaying on a 24-hour basis. And so if you wanted to calculate the actual theta of a spread, it's very simple. You're going to take the theta of one option and subtract the theta of the other option. So in this case, if you had, say, the spread's worth $1.70 and it's got 28 days, it might have 5 cents of theta in it. What that means is that maybe the 90 call might have 7 cents of theta and the 95 call might have 2 cents of theta. And so you're actually collecting 7 cents in theta on a daily basis, but paying out 2 cents in theta. And so your combined theta of that would be 5 cents. You can think about it that way. It's not guaranteed, just like theta of any option is not guaranteed. Theta of a spread is not guaranteed, but you can calculate it that way if you want. Now, let's look at the example as far as P&L is concerned. Remember, you're short the 90s, you're long the 95s. This is a bare call spread, credit spread. Max profit, again, is what you took in when you sold the actual spread. So max profit is going to be 170. Max loss is going to occur when both of those options go in the money. So once the stock goes above 95, both of these options are theoretically in the money, and thus that call spread is going to be worth its maximum amount of $5. In that case, you're going to lose $5 minus the $1.70 that you took in when you sold the spread. And again, your break even is 91.70 because you collected $1.70 to actually sell this spread. Now, what happens at expiration? This is the interesting part about all of this. You have 3 basic scenarios. One is that the stock ends up below both strikes, right? If it stays at 88.5 and it's below the 90 strike and also below the 95 strike and all the other strikes above that. The other is that it goes above the 95 strike, right? So that the spread is worth the most that it can be worth. And then the third possibility is that it actually settles somewhere in between. So let's look at all 3 of those. The first one is below the 90 strike. In this case, both of these options should theoretically expire without value. Both of them should go out essentially worth 0 and most likely going to be not exercised because the person who's long that option is not really financially incentivized to exercise that position. And so what you're going to end up with theoretically is the $1.70 that you sold this spread for is going to stay in your account just like it has always been, but you're going to have to do nothing essentially. Both of these options are going to go out worth 0 theoretically. The only thing you need to worry about, and this speaks to what I talked about at the beginning, is the assignment risk portion of this, the expiration part of this. If the stock is close to the 90 strike, where you are, remember, short optionality, the uncertainty of assignment on the 90 call results in the uncertainty of a possible stock position after expiration. Where does that stock position come from? If you were to be assigned on these 90s, you would theoretically, because you incur the liability of making that contract whole, someone who is exercising the 90 call is converting that call into a long stock position at 90. Thus, you are incurring the obligation of making that contract whole. You have to deliver the stock at 90, essentially. If that happens and you are assigned, you will theoretically have a short stock position. The reason why I mention this is because oftentimes when we're right at 90, if you're right at your short strike, you don't necessarily know if your call is going to be assigned. And so that's something you need to pay attention to and understand that. Remember, I said at the beginning, when you have a spread position on, you're both short and long optionality. And it matters where the stock is. Because if the stock is trading 85, the short optionality you have at 90 doesn't really come into play. But if the stock is trading 90 at expiration, that short optionality is real, and that option has a very different profile of its likelihood for exercise and thus assignment if you're shorted. Pay attention to that and make sure you understand when the stock is close to 90, you need to be paying attention to the short optionality that you have. One quick thing, the only surefire way to completely close out your assignment risk is to close short optionality positions. So in this case, if you're short the 90s, the only way that you can completely remove your exercise and assignment risk is to close the 90s. That's the only way you can completely do it. Now, if the stock's trading 85, you may not need to do that, because what are the chances of it trading through 90 right after expiration? That may be very low. That doesn't mean that it can't happen. Okay. Now, the other scenario that we talked about is above 95. In this case, both of these options are going to go out worth something, worth some amount of intrinsic value. The spread is going to be worth $5, and your actual max loss is going to be $330 because it's $170 minus the $5 that this spread is going to be worth at expiration. So stock above 95, you're going to lose $330 on this. Stock below 85 or stock below 90, you're going to make $1.70 on it. Now we get to the interesting part, between 90 and 95. How does this work? If the stock goes out between 90 and 95, there is some likelihood that you are going to be assigned on your 90 calls. In that case, you are going to incur, like I said, the liability of making that contract whole. That means you're going to be short the stock at 90. Now, if the actual stock goes out below 91.70, your spread position is going to still be profitable. However, you may have a resultant short position in the stock from the 90 call. Pay attention to that and make sure that when you're looking at it, if the stock's trading 91, don't think, oh, I sold this thing for 170, my break even's 91.70 and I'm fine, like whatever. Because at that point, you're actually still profitable on the prices that you traded. However, if someone exercises that call and you are thus assigned on that call, you also have a short stock position and all of the risk that goes along with that short stock position as soon as these options expire and you're assigned. So make sure you keep track of that as well. That's something that's really, really important when you're trading in between those two strikes. Let's look at the same thing on the put side. This is going to look very similar, but it's just on the put side. So I'm going to move quickly through this. The motivation here is the exact opposite of the motivation for the call credit spread. The put credit spread, puts are negatively correlated to underlying price. And so when stocks go up, puts usually go down in value, and the exact opposite. When stocks go down, puts usually go up in value. Thus, if you're selling a put spread or creating a put credit spread, you are theoretically going to be neutral and or bullish on the underlying. Again, these spreads have defined risk and reward. Same characteristics here. Favorable break-even points. The credit that you pull in moves your break-even point, and the profit is very heavily influenced by the amount of credit you receive. Same thing here. Risk control. Defined profit potential. That's what the actual spread itself creates. Defined maximum loss. Also, that's a part of the long and short optionality together in one position. And again, just like I showed you as far as the call spread is concerned, the position monitoring is critical, especially around expiration. And for the exact same reasons, but in the opposite direction. Because when you're short downside put spreads, which we're going to look at right here, you're short the strike that's to the downside, not the strike that's to the upside, like in the call spread situation. We'll look at that in just a moment. Let's take a look at the put credit spread example. On the same theoretical stock trade in 88.5, same days to expiration, everything's going to line up almost exactly the same here, except you're going to be selling and buying different strikes on the put side. So in this case, it's the 28-day 80-85 put spread. You're going to be selling the 85s for 205, and you're going to be buying the 80s for 70 cents. Net credit's $1.35. That's how much you're taking in. Again, the $1.35 stays in your account once you sell this spread. That part doesn't change. If you were to sell this, you are going to be what we call short the 80. Some people call it the 80-85 put spread. Some people call it the 85-80 put spread. It depends. But if you were to say, I'm short the 80-85 put spread, or I'm short the 85-80 put spread, people are going to know what you're talking about, because the actual spread itself is the difference between the 80s and the 85s. And if you're short it, that means you're short the bigger option and long the smaller option. So it doesn't matter which way you say, which strike you say first, as long as you say I'm short it, people are going to understand what you're talking about. Now, this again is a neutral or a bullish spread because of the fact that puts are negatively correlated to underlying price movement. So let's take a look at what this might look like in real terms. So again, stocks trading 88.5, 28 days to X. The 85-80 put spread you've sold for $1.35. Max gain is what you sold it for. Max risk is the difference in the strikes minus what you've sold it for and already created as far as the actual credit is concerned. So in this case, $3.65, that's $5 minus 135. Your margin again is going to be 365. Theoretically, that's going to be variable depending on your brokerage account. And your break even, this part is not going to be theoretical, is 83.65. Why is it 83.65? Because 135 of credit is kind of like the cushion that you add to the downside, meaning the 85 strike would be, if you were long stock from 85, your break even would be 85. But in this case, you're short the actual optionality and you've taken in $1.35. So that gives you this kind of what we would call a head start on the downside. And you actually subtract it from the upside strike to give you more room to the downside. That's why your break even is 83.65. It's lower when you're short put spreads and higher when you're short call spreads. Again, lots of people like to talk about like the actual decay of spreads because of the fact that they have, defined optionality, but they also have the characteristics of decay because you're actually short a bigger option than you're long. You're actually creating credit when you sell them. You can calculate, again, the actual theta of this spread by taking the theta of the big option minus the theta of the smaller option. And that'll theoretically give you the theta of the spread, which you can theoretically expect to see on a daily basis if absolutely nothing happens. It's important to build that into your risk matrix, but it's also important not to fully rely on that as something that you expect to see no matter what. There's a lot of things that can go on with implied volatility, skew, kurtosis, just all kinds of things. So make sure you think about it, but don't rely on it as a guarantee, because it's definitely not a guarantee. Let's look at the P&L of this. You're selling the 85-80 put spread. Again, max profit is what you take in when you sell it. You're going to look at this and see that it looks very similar to the call spread P&L, but flipped. That's all this is. Same optionality, different strikes on the put side. So your max profit's $1.35, what you sold it for. Your max loss is $3.65. That's going to be the difference in the actual strikes of the spread minus what you sold it for. So in this case, 5 minus 135, and your break even is going to be that amount that you took in taken away from that upside strike. So you can say you add it to it or you subtract it from the upside strike, but essentially what it does is it shifts favorably your break even, in this case down, and gives you a little bit more cushion to the downside. That's what it looks like from a P&L perspective. Now, what happens at expiration? This is the exact opposite of the call spread. What happens at the call spread expiration? If the stock goes out above both of these strikes, both of these options should theoretically go out worthless. Now, assignment risk here, again, is the same as the call spread assignment risk. If you're close to this strike, pay attention to where the stock is. The difference here is that if you are short puts, you have incurred the obligation to actually take delivery of the stock. And so in the case where you're short calls, if someone exercises and you're assigned, you have to deliver them the stock, which makes you short the stock. If you are short puts and someone exercises and you are required to make that contract whole, you must take delivery of the stock and be long the stock. That is your resultant position if you get assigned on puts, is you are long stock. If you are assigned, you incur all of the liabilities and the actual position management that comes with being long stock, because you are long stock now. Your option position has been converted into a long stock position. So it's important to pay attention to that so that you understand, especially if the stock is close to 85, there's a potential for you to be assigned on those puts. All right. Stock below 80, this is the max loss point of this position. Again, it's because the 80s and the 85s are both in the money. They're going to have intrinsic value at expiration, and thus the spread itself is going to be worth $5. Once the spread is worth $5, your max loss is the difference in the strikes, $5, which is what the spread is worth, minus the $1.35 that you've already taken in. Most of the time, this short put here is going to be assigned on the 85 strike. And most of the time, if the stock is below 80, you're going to exercise your 80 put. And so theoretically, this whole thing is going to P&L as if you bought stock at 85 and sold it at 80. That's where the $5 comes from, essentially. But in reality, the $5 comes from the fact that the put spread itself that you sold for $1.70 goes out worth $5. So that's what happens below 80 on the put side. And then, of course, the interesting part is in between these two strikes. Sorry, let's go back. In between these two strikes, that's when things are a little bit more interesting. What's the likelihood of me getting assigned on my 85s? Do I need to exercise my 80s in order to sell the stock out that I'm theoretically going to be buying because I'm short that 85 put? You need to pay attention to that. Between the strikes, you're probably going to be assigned on your short leg, and you need to make a decision as to whether or not you want to exercise your long leg. Okay, now that we've talked about the building blocks of these spreads, let's talk about the spreads themselves. We're going to get into slightly more complex spreads here. This has been a kind of deep explanation of the building blocks, the simple spreads that make up these more complicated spreads. The first one we're going to talk about is the iron condor. All right, some people tend to look at a situation and think that a stock might be range bound. They're either neutral on the stock, or they think that nothing's going to happen, or that actual delivered volatility is going to be far less over the course of the option's lifetime than what's priced in right now. Those situations are theoretically potentially situations where people might want to trade iron condors. The reason why you might want to trade an iron condor in that situation is because the iron condor is a combination of both the call credit spread and the put credit spread that we just talked about. So this is where you could use iron condors. An iron condor is the sale of a call credit spread and the sale of a put credit spread. So I want you to think about that. What we just did is looked at the P&L graph of the call credit spread, which is what this is, and the P&L graph of the put credit spread, which is what this is. So what do you get when you put them together? It's usually the same underlying, the same expiration month, both spreads are out of the money spreads. Remember, we talked about this stock being an 88 half, it's trading 88 half. So the 90-95 call spread is out of the money, as well as the 80-85 put spread. Let's look at a real world example of this surrounding that same situation that we talked about. Stock's trading 88 half, 28 days to expiration, and you might have a theoretical idea that this stock's staying between 85 and 90 until it expires. You might think there's resistance at 90 to the upside, there's support at 85 to the downside. Some people like to look at charts and see support and resistance levels and decide that this range is where the stock's going to be for the next 28 days. And if that's the case, this could be a perfect way to express that idea. You sell the 90-95 call credit spread that we talked about at the beginning. You also sell the 80-85 put spread that we talked about at the beginning. And those two trades cumulatively create the iron condor, which gives you a net credit of both of those spreads combined as one giant credit spread. Now you're gonna have 4 strikes on, right? 80, 85, 90, and 95. The 80 and the 85 are gonna be the downside put spread. The 90 and the 95 are gonna be the upside call spread. This is a typical iron condor. This doesn't mean that this is like the only way to create an iron condor. What this means is, generally speaking, if you're dipping your toe in the water and trading an iron condor for the very first time, this is probably what it's going to kind of look like, right? It's going to be all within the same month. It's going to be equidistant strikes, hopefully, because that gives you a really good idea of what that defined risk might look like. $5 strikes, $5 strikes, right? The most the put spread can be worth is $5. The most the call spread can be worth is $5. And I can guarantee you of one thing. At expiration, both the call spread and the put spread cannot be in the money at the same time if they're separated by that amount of distance. That I can guarantee you. And that's part of the way that this strategy is kind of built, is that you can't be theoretically exercised, or you can't be theoretically assigned on both of those spreads at the moment of expiration, because both of them can't be in the money at the same point in time. Let's look at what this might look like from a P&L perspective. You're selling the 80-85 put spread and the 90-95 call spread. Both of these spreads are out of the money, and the total is 305 that you're taking in. So the max gain here is going to be 305. The max risk, again, is going to be $1.95. Why the max risk 195? Like I said, both of these spreads cannot be in the money at the same moment of expiration. Only one of them can. If one of them is in the money by some amount, even its maximum amount, the other spread cannot be in the money. So your max risk is $5, the difference in one of the spreads, or the difference in one of the 2 strikes of that spread that create a $5 spread. In that case, you would lose $5, but you would have collected 305 to put the spread on. So your max risk would be 195. Your margin might be 195 in that situation. The break even is added to the upside call strike and subtracted from the downside calls, the downside put strike. What I want you to think about is that premium that you've created creates this kind of cushion in which the stock can kind of like bounce around within there. And if it doesn't break through to the downside, 81.95, or upside 93.05, you're going to have a profitable position, assuming that you didn't hedge it or do anything crazy with it. As far as you're selling it at 305, these are going to be your break evens. Now, what does that look like from an actual P&L chart? It looks like the combination of the call spread and the put spread together. You'll recognize this because this is your put spread and this is your call spread. And you just basically traded both of them. You essentially traded one versus the other, but what they create is this kind of plateau in the middle. And this is the area in which you're going to look at and think about is your kind of that cushion that I talked about, where you might see the stock bounce around in between 85 and 90 and 87 to 91 and then back down to 84. But as long as it stays within this range, especially at expiration, you're going to have a profitable trade. One of those spreads might even expire worth some amount of value, but as long as it doesn't expire more than 305 away from the inside strikes, we call these the inside strikes of the Iron Condor, and we call these the outside strikes of the Iron Condor. As long as it doesn't expire farther than 305 away from the inside strikes, it's going to be a profitable position. It's going to be within your break evens. The point that exists with call and put credit spreads on their own, where I talk about the fact that they incur both long and short optionality, is also true here. You have both long and short optionality, but now you have it in 4 different strikes, right? The 80s, the 85s, the 90s, and the 95s. It's important to pay attention to this just as much as it is in the other way. Many times people will look at this and say, well, I'm short both call optionality and put optionality, so like it doesn't matter. I don't have to look at it. It's all going to work out. I would say that's not the best possible way to look at risk. And the reason why is because there can be situations in which you trade outside of these strikes in between the time that it expires, and the actual dynamics of this spread could change very much between, especially if you still have a lot of time left to expiry. In those situations, it's possible if the stock stays there and you fast forward up till expiry that there may be a situation in which you get assigned on something before it actually expires, and you need to pay attention to what that might create as far as the underlying stock position that you might have. The only time you really need to think about that is when you're trading American style options as far as early exercise and assignment is concerned. If you're trading European style options, meaning if you're trading a strategy like this on something like an index that has cash settled European style options, those options can only be exercised at the moment of expiry. American style options, which the vast majority of equity options are American style options, maintain the right to exercise at any point in time during the life cycle of the option. And so if you're long that option, you can exercise it whenever you want. And if you're short the option in an American style option, you incur the liability of being assigned at any point during the lifetime of that option. Important to pay attention to that, especially if you're trading American style options. Just pay attention to where the stock is relative to where your long and short optionality. That's the basics of that entire diatribe I just laid on you. Okay, let's talk about the Iron Butterfly, because the Iron Butterfly looks almost exactly the same. You'll notice a difference when we get to the P&L of it, and the P&L kind of graph of it, because there's a certain part of that P&L graph, the plateau part, that doesn't exist in the Iron Butterfly. In this case, XYZ is trading $90. We moved it up so that I could give you an example that surrounds the $90 strike, 28 days to expiration, and you're thinking maybe similarly to the actual Iron Condor, maybe with this Iron Butterfly that the stock is going to trade between 85 and 95, and then it's going to stay in that range until expiration. So one possible Iron Butterfly example is selling the 90-95 call spread for $2 and selling the 85-90 put spread for $205. One thing, like I said, that you're going to notice that is different in this case, that is different than the actual Iron Condor, is there's no difference between your two short strikes. You'll notice you're short both the 90 call and the 90 put. What we've done is we've taken out that plateau part of the P&L graph. Now, in exchange for taking that plateau part out and giving yourself more actual room and more of that cushion, what you end up with is obviously taking in more credit when you sell it. The reason why is because the 90-95 call spread and the 85-90 put spread are going to be originally when we talked about the iron condor, you sold the 90-95 call spread and the 85 and the 80-85 put spread. Well, when you move both of those strikes up, the 85-90 put spread, that spread's going to be worth more than the 80-85 put spread. And that's where the difference in this credit comes from. The put spread side of this that we've just moved up is actually worth more and thus creates a larger net credit for the entire thing. But the basics of this are almost exactly the same. You're selling a call spread and you're selling a put spread. But what you're selling is the at the money call spread and the at the money put spread. So let's take a look. This is obviously like I said before, the typical iron butterfly. This is the typical iron butterfly. The typical iron condor is what we looked at before. If you're dipping your toe into the water and selling iron butterflies, this could be an example of what looks like a very typical or beginning iron butterfly idea. It's $5 strikes, $5 strikes, $5 put spread, and $5 call spread. Makes things simple, one by one by one by one. In this case, you're selling the 85-90 put spread and the 90-95 call spread. You're taking in 405. That's your max gain. Your max risk is going to be, again, the difference between the two strikes of one or both of those spreads minus what you've taken in already. In this case, you've taken in 405. The most those call spreads or put spreads can be worth is 5. So your max risk is going to be 95. In this case, your actual margin might be 95 cents, and your break even is 95 cents on either side of the 90 strike. All right, let's take a look at what the P&L of this looks like, because like I said before, you're going to notice a pretty stark difference between this, but very similar characteristics. The 90-95 call spread and the 85-90 put spread. You're taking in 405. Keep in mind what you have done here is you have taken the difference between these two put spread and call spread strikes out. And what you have now is the put spread with the short strike being the 90s and the call spread with the short strike also being the 90s. Sometimes this position by people who kind of understand option dynamics will be described as being short the meat and long the wings. The reason why they say that is that these options are bigger and or meatier options. You're short more premium than you're long. And in this case, as long as the stock stays within this 85.95 to 94.05 range, this position is going to be profitable, or it's going to be within its break evens at expiration. The same dynamics that I explained at the beginning as far as the put spread dynamic and the call spread dynamic when you're talking about being in between those two strikes at expiration, in this case, in between the 85s and the 90s, or in between the 90s and the 95s at expiration, those same dynamics apply here, but they apply in both directions. So in this case, you're taking in more premium. You're taking in a full $1 more of premium, which is north of 30% more premium. But what you're also incurring is the actual gamma and the you're exposed to the actual movement of the underlying more acutely because you're short both the 90 call and the 90 put. There's no difference between the put that you're short and the call that you're short as far as the strikes are concerned. What we've done is we've taken those put spreads and those call spreads and we've just jammed them together. Again, what that does is it creates more premium that you're taking in when you sell it, but you're also more exposed to the movement, the underlying movement of the stock because you're short both the at the money options. You're short the 90 call and the 90 put. And so another way that people who would call it you're short the meat and long the wings would say is you're short the straddle, which is the 90 call and the 90 put, and you're long the strangle, which is the 85 put and the 95 call, meaning you're short the at the money options and you're long the out of the money options. The straddle on the inside and the strangle on the outside. What this does is it gives you that defined risk characteristics from both the put credit spread and the call credit spread, but in both directions. If the stock were to go out below 85, you could theoretically exercise your 85 put and be flat stock. If the stock goes out above 95, you could theoretically exercise your 95 call and be flat stock. You're not going to have any ability to affect change in whether you're exercised and whether you're assigned on the 90 call and the 90 put, because you've sold that optionality to someone else. And so what this does is that's what actually creates the actual exposure to the underlying that's more acute and based in one point on the stock than the strangle or than the condor, which actually has a distance between the two short strings. Okay, that was a lot of information. If you want more information on this, make sure to get in touch with us at options@theocc.com. This is the email address that I mentioned earlier. And optionseducation.org is a fantastic resource where we have all of our educational resources centered on our website. You can go there and check out all kinds of things, webinars, YouTube videos, podcasts, et cetera, et cetera, et cetera. So, Andrew, do we have any time for some Q&A? I think I left a whopping 4 minutes.
Harvey asked, at what time does an option stop trading on expiration day?
Ooh, that's a great question. It depends on the option, number one. Generally speaking, options print at 3 o'clock on the actual, at 3 o'clock central on the actual expiration day. And so the last print of the stock is what many times people will use to actually like say, this is where the stock went out and this is what the option is worth. There is a time period after the close. If you're trading, specifically if you're trading index options, where there's an adjustment period where like there's 15 minutes afterward where options tend to continue to trade. But the other thing that's really important that I always talk about when we talk about exercise and assignment is you need to understand at what point during the day your brokerage firm cuts off your ability to exercise your option. The reason why is this. If things stop trading at 3 and the stock prints and it has, let's say, earnings, and the stock goes up by 10% in the 30 seconds after the close, and you're long the at the money call, you want to know whether or not you have the ability to exercise that option after the close and for how long. That makes a big difference in whether or not you're going to be profitable on that trade, because if you're long the 90 call and the stock's trading 97 all of a sudden, you are financially incentivized to want to exercise that call. That cutoff time varies from brokerage to brokerage. So it's important that you understand how long after the close you have to be able to tell your brokerage firm, hey, I know this call exercised 2 pennies out of the money, or I know this call expired 2 pennies out of the money, but I want to exercise it because the stock's trading $7 through the strike. That can be a situation that occurs. It can be a possibility. Make sure you understand where your brokerage firm cuts off your ability to exercise your options.
I think you anticipated the next question there on that, so thank you for that, Matt.
Indeed.
Lewis asks, can we see those strategies directly on Trader Workstation, or is it just in the presentation? If you use the option chain, you can go to the strategy builder just by turning the button on, and then there. Matt, do you have a good explanation for the probability of profit, its definition?
The probability of profit. Ooh, that's a good question. I don't think I have a good definition for that. The reason why is that your probability of profit is so dependent on how much premium you're taking in, especially with these strategies, or how much premium you're paying for a strategy if you're buying it and creating a debit spread, or just buying options in general. It's so variable relative to the notional value of the options and the underlying, and there's a whole host of different things that are built into that. So I can't give you a really good formula for that. What I can tell you is, generally speaking, the more premium that you take in when you create credit spreads, the more cushion of profitability that you've built into the position itself. Like I mentioned at the beginning when we're talking about the call spread and the put spread separately, that the actual profitability of those spreads is very inherently dependent on how much you sell it for. The reason I mention that, oftentimes people will, before they encounter a situation where they see how like outsized moves in stocks can really monkey with spread positions. Sometimes people will say, oh, well, this is a defined risk characteristic spread. I'll sell it for a nickel or something, right? Very low amounts of premium. Generally speaking, that's referred to as selling, like picking up nickels in front of bulldozers, right? Like that's a phrase that exists for a reason. It's important that you understand that so much of profitability and so much of your break-even points is based 100% on how much you're actually taking in when you sell these spreads, credit-wise. So selling them for very tiny amounts of money isn't necessarily always the greatest of strategies.
Right. Okay. This is a good question. What are the long and short positions when we refer to butterflies and condors?
What's the question again? What are the long and short?
Yeah, so you can have a long version of the butterfly and a short version of the butterfly, right? What's the difference between the two?
Absolutely. As far as let's talk first about the butterfly. Being long the inside strikes of the butterfly. So in the case that I showed you, let's go back and I'll show you. In this case, the graph would be inverted. And so you would take this and it would be down here, the 90 strike. So in this case, you would be long the 85-90 put spread and long the 90-95 call spread. What that means is that you want the exact opposite to happen that you do when you're shorted. Because you're long optionality at 90, you want the thing to move, right? You want it to move away from the strike. Anytime that you're long optionality in one place and short optionality in the other place, generally speaking, you want whatever you've got going on to move away from your long strike and to your short strike. That's like page 3 in the market maker manual when they teach you about risk management. When you're getting close to expiration, as long as things happen in a gradual way, you want things moving away from your long strikes and to your short strikes. The reason why is because as you get closer to expiration, those options decay. And what you want is to be as far away from your decaying options that you're long and as close to the decaying options that you're short, because that means that the actual decay is helping your position instead of hurting your position. In this case, if you were long the inside strikes and short the outside strikes, you're going to be paying theta or incurring the actual decay anytime the stock is in between these two break-even points, 85.95 and 94.05. So you want it to be outside of those areas instead of inside those areas.
Real quickly, how do you calculate the delta of the vertical spread again?
Oh, good question. The delta of the vertical spread is very easy to calculate. It's just like calculating the theta of the vertical spread. You take the delta of one option and you subtract the delta of the other option. So in the case of with the stock trading 90, let's say the 90-95 call spread, that 90 call, the at the money call is going to have a 50 delta. The 95 call might have something like a 25 delta. In that case, since you're, long one and short the other, you would be, and if you were long the call spread, you'd be long the 50 delta call and short the 25 delta call. And so the spread delta would be one minus the other, 50 minus 25. That spread would have a 25 delta. You would expect, based on the theoretical delta of that from your perspective, that the spread itself would move 25 cents for every $1 move in the underlying.
Butterflies and condors, is one better than the other? Which one has more risk?
Well, I guess if you think about okay, so risk is always, to me, a two-sided coin. It's all about how much you're taking in versus how much you're actually risking. The iron butterfly is going to be more sensitive to movement because of this, right? Because of this point right here. It's going to be more sensitive to movement, but you're also taking in more premium. The iron condor is going to be less sensitive to movement, but you're also not taking in quite as much premium. And so that's what I mean when I say there's two sides to that coin. There's always two sides to that coin. It's all about, and one of them isn't any better than the other one. It's all about what your idea of your forecast of how you think things are going to play out and how you can find a way to best express that incorporates not only your risk tolerance, but also what you think is going to happen. And so for some people, the better trade is the iron condor. For some people, the better trade is the iron butterfly. The important part here from my perspective is that you understand that both of those complex spreads are really just the smashing together of the two simple spreads that we talked about at the beginning. It's just you're smashing them together in different ways. That's all it is.
Very good. Matt Cashman, thank you very much for joining me today. Always a pleasure. And we'll speak to you next month.
Yeah, right on.
All right. And thanks to the audience. And don't forget to look out for the follow-up email later on this afternoon. Thanks, everybody. Bye for now.